Okay, question 10. If a portfolio manager is trying to maximise the risk-adjusted return, they'll seek to invest in more securities that have what? Now, the question here obviously is talking about Jensen's alpha. Okay, and Jensen's alpha is basically linking to CAPM. Okay, so if I think about CAPM, okay, so the capital asset pricing model, what it gives me is what we call the securities market line. Okay, and securities market line is basically saying that I can look at the expected return against beta. Okay, and it's basically saying for a given level of beta, I should get a predicted expected return. Basically saying I should be on that line. You know? So if I've got a security that's got a beta here, let's call it beta 1, I should get that return R1. Okay. Now, in reality, it doesn't always work out like that. And sometimes you'll find if you've got an asset that's got a beta of 1, then its return might be higher than R1, might be lower than R1. So let's just mark R1 here just to be clear what we're doing. Okay, so I might actually have a return up here or a return down there. Okay, let's call this R2 and this one R3. Now, clearly, for a given level of beta, I'm going to much prefer to have R2 than R3. Okay, and what the question is actually asking for here is what are you looking for? Are you looking for R2 or are you looking for R3? Well, clearly R2. But when we look at R2, because that return is higher than what we expect from the securities market line, we actually say that this has got positive Jensen's alpha. Okay. More commonly, we probably say it's got positive alpha. Okay. But that's what we're actually looking for here. We're looking for the securities that sit above the securities market line. This one, R3, we say that one's got negative alpha. Okay, we don't particularly like that one. Yeah. So if you are looking for alpha, if you're looking in particular here for positive alpha, you're looking for securities that sit above the securities market line. Those that are, you know, to a certain extent, we think are mispriced. Now, if we can identify these securities, because they give us a better return than what what the SML says we should be getting, we actually try and seek these out. Now, the issue with them, of course, is that if you're looking for them, other people are looking for them as well. And as the market identifies these securities, what will happen is we'll all start buying these securities. And as the securities are getting bought and bought in the market, the price of those securities will rise. Yeah? And as the price rises, the yield returns. Yeah? So the argument is that eventually that security will take its place where it belongs on the securities market line. So as the pricing is corrected in the market, it then returns to where it should be. It sits on the SML. Now, when you have a security that has got negative alpha, so let's think about our security that we've marked as having a return R3, essentially what we're saying here is we don't like this. This is not giving us the return that we want. You know, we expect to see a return R1, but it's actually giving us a return a bit lower. So what we're going to do here, if you hold it, you're probably going to sell it. Okay? What you might actually do is sell short. But generally what's happening is the market is selling that security. And as the market sells the security, what's going to happen? The price will go down. As the price goes down, the yield will go up. Okay? So again, the idea is that over time, the market should correct the mispricing, and that security should take its place where it belongs, again, back on the SML. Okay? Now, the question is actually saying, okay, that's all fine, but what we're looking for here, well, when you're trying to maximise your risk-adjusted return, what you're actually looking for is positive alpha. Okay? So what you want to do is have higher values of Jensen alpha. Okay? Note, by the way, that this one here has got alpha equal to 0. So that's basically what option B in the question is referring to. Okay?